Welcome to this pivotal moment in stock market history where the unexpected becomes real. Just when you thought the market had dealt us all its cards, the game turned drastically. The financial world held its breath in expectation only a few moments ago. Elon Musk, the mysterious founder of Tesla, just revealed something shocking to Wall Street. Tesla tweeted that quotation this morning. In order to achieve a stock split, end quote, Tesla will put the authorization of extra shares to a vote among shareholders at this year's annual meeting. Additionally, this morning, Tesla filed a new 8K with the SEC outlining the same information. Don't be misled by the verbiage. While a dividend is mentioned, it refers to a stock dividend. This is the exact same split structure that Tesla has previously employed, so this is not them. Setting up a quarterly cash dividend on the stock was then reported on Twitter this morning by CNBC's Philbo, who stated that Deutsche Bank had increased their Q1 earnings expectations. Phil claims that Deutsche Bank stated that they are increasing their forecasts because, although I haven't seen any publications on this, beyond this quarter, we continue to be impressed by Tesla's operational execution in the face of industry supply chain challenges and by its pricing power, which could allow it to more than offset the sharp pressure on raw materials. In today's special episode, we'll delve deeper into this groundbreaking announcement, which is very similar to the conclusions that we have heard other analysts reach. How will Elon Musk's most recent action affect investors, the market, and the prospects for electric vehicles? What does it imply for Tesla stock? Stronghold, from the fine print to the big picture, we've got you covered. This isn't just another market update. Join us as we unravel the mystery, analyze the consequences, and explore the uncharted frontiers of Tesla's market journey. This is Tesla Hype, where finance and the future collide. Stay tuned as we prepare to go on an exciting journey through the world of stock strategy and Elon Musk's brilliance. Welcome to an exciting edition of Tesla Stock News, which you will definitely enjoy. Furthermore, join our channel. Let's begin by kicking off the holiday season. There is a distinct subject that requires our focus. Possible third stock split for Tesla. We haven't talked about this topic on this channel before, but it seems appropriate to do so now that Tesla appears to be about to make another significant T breakthrough. It's important to comprehend both the advantages and disadvantages of a stock split. Though keep in mind that past performance does not guarantee future results, Tesla's behavior during its last two stock splits historically paints an interesting picture. Tesla's shares increased by 81% in August 2012 between the announcement and the split, then fell by 14% the next month. Nevertheless, the stock recovered spectacularly, rising by roughly 36%. 6 months after the initial split of this 5-for-1, shares were practically quintupled, and the price of a share fell by a fifth. Fast forward to August 2022, when Tesla revealed its second split. This time a 3-for-1 split. The goal was to increase employee and investor access to stock ownership. Prior to this split, Tesla stock was trading at about $1,900, a significant increase from over $2,000 before the first split in 2020. After the announcement, the stock rose by roughly 46% to about $1.3115 per share, but subsequent events saw a 15% decline. Elon Musk, the CEO of Tesla, started talking about the company's acquisition of Twitter and the subsequent sale of Tesla stock, which marked a significant turning point in the company's history. This period also coincides with the observation that Tesla stock has seen impressive gains after its previous two splits. As we approach 2024, the first split performed significantly better than the second, which was ascribed to different market conditions. Although interest rates aren't at zero, they are on a downward track that could lead to a scenario comparable of 2020. According to market conjecture, 6 to 7 rate cuts are possible. Market lubricity rate cuts are a tactic used by central banks, such as the Federal Reserve in the U.S., to encourage economic activity. By lowering interest rates, borrowing becomes more affordable for both individuals and businesses, which encourages higher spending and investment and can accelerate economic growth. The projected course for 2024 reflects the financial climate of 2020 following the COVID-19 pandemic, while interest rates in 2024 are not anticipated to fall to the historic lows seen in 2020. Central banks around the world slashed interest rates to nearly zero levels to mitigate the economic fallout. These cuts were part of a broader strategy to maintain market liquidity and encourage spending and investment during a period of global uncertainty. The anticipated sequence of rate cuts points to a change in monetary policy that is more accommodating. This change is thought to be a reaction to a number of economic factors and indications. Reduced interest rates typically lead to an increased market Liquidity at times when borrowing costs are lower, when money is flowing through the economy, companies are more willing to invest in expansion prospects, and consumers may increase their spending on goods and services, which can result in a more lively and dynamic market. The balancing act makes sure that the rate cuts don't overstimulate the economy and put investors at risk of inflation. The rate cuts that are anticipated for 2024 could indicate a change in economic priorities following a period of controlling inflation or economic recovery. Lower rates can make equities more appealing than bonds, increasing the stock market. The anticipation of rate cuts frequently delivers a bullish outlook. Cheaper borrowing costs also benefit investment companies, possibly enhancing their stock prices and financial performance. The upcoming year suggests a more accommodating Federal Reserve, which could foster a favorable market environment, especially for interest rate-sensitive stocks like Tesla and even impact small and mid-cap stocks. This stands in stark contrast to the situation in 2022 when market liquidity was consistently being drained. The talk about the possibility of a Tesla stock split in the upcoming year has grown. Previously, when the company's shares were trading between $150 and $200, the idea seemed improbable. However, as the stock could reach unprecedented heights in 2024, the discussion has gained credibility. Projections for 2012 to 2024 range from a bullish scenario of $600 per share to a bearish estimate of roughly $350. According to a recent article from 247 Wall Street dated November 4th, there is a chance that Tesla will split again if shares surpass $400 in 2024. The main reasons for this are to make the stock more accessible, particularly for people who can't buy fractional shares through certain brokers like Vanguard stock splits, and to make stock-based compensation for employees simpler. Interestingly, past stock splits have served as catalysts, significantly increasing Tesla's market attention. For instance, in August 2020, Tesla shares jumped 81% between the announcement and execution of the split. While stock splits don't inherently increase a company's value, they have historically attracted increased investor interest and retail inflows, posing challenges for short sellers. Furthermore, another stock split might position Tesla as a potential component of the Dow Jones Industrial Average. This prestigious index, comprising 30 of America's most prominent companies, currently lacks an automaker since General Motors' removal in 2009. Tesla's profitability and status as an iconic American brand make it an attractive candidate. However, the Dow's price-weighted nature means that Tesla's stock price will significantly influence its potential inclusion and weighting within the index. As of late 2023, only one Dow component trades for over $1,500 a share, suggesting a preference for Tesla to trade between $100 and $1,200 per share, rather than higher prices above $1,400. The likelihood of Tesla splitting its third stock is increasing, especially if its stock price rises above $400 or even $300 per share. This action could have a big impact on the Dow Jones Industrial Average and prevent Tesla's performance from having an outsized impact on the index at $1,400 per share. By 2024, it's feasible that Tesla's market capitalization might reach about $1.25 trillion. Target, given the company's direction, has managed to generate great performance despite confronting the highest interest rates in its history and navigating inflationary pressures. Interest rates are expected to decline more quickly than the cost of financing new cars could be reduced by market expectations, which could improve consumer spending power and Tesla's sales in 2024. Tesla may also raise the price of its automobiles. Since a monthly payment of $1,650 is more doable than one of $1,900 or more, it becomes imperative to concentrate on the monthly payment portion that is essential to consumers' affordability. Even if it lowers margins, this pricing model may ultimately prove more advantageous for Tesla and more realistic for consumers. Given market conditions, Tesla's present valuation, which is low by corporate standards, reflects elevated borrowing costs, and public doubt around Elon Musk. Tesla's stock performance has also been impacted by Musk's remarks during earnings calls, but there is still opportunity for valuation growth in 2024. Assuming $4.50 in earnings per share, the price-to-earnings ratio could return to around 100 in 2024, a significant decrease from its peak of 1,200 in 2020 and 2021. If EPPS meets or surpasses estimates, Tesla's stock price might reach $1,450, opening the door for another stock split. Splits don't alter the company's underlying valuation, but they can increase stock accessibility for a larger group of investors, particularly those who can obtain fractional shares. In the case of companies like Berkshire Hathaway, where the stock price is exceptionally high due to few shares and the stock undergoes considerable daily changes. This accessibility could potentially drive the stock's price higher. A stock split could stabilize the fluctuations of the stock by increasing the number of shares while lowering the price of each individual share. Somewhat by raising the number of shares outstanding, Tesla may be able to maintain its valuation and attract more private investors to its stock. It's predicted that Berkshire Hathaway stock would be less volatile and may experience less severe drops in value over time if it were to experience a number of stock splits. This can result in a more steady valuation for the business. Based on its 2 prior stock splits, Tesla's experience indicates that these kinds of moves can help sustain high stock values notwithstanding strategic choices made by the company, such as price reductions. Although Tesla's valuation fundamentals have changed, the stock is still much higher than it was in 2019. It is thought that the company's stock splits contributed to the preservation of this value. Furthermore, stock splits may provide minor advantages to individual investors. For instance, in the event of a 1-for-4 stock split at Tesla, a shareholder with 25 shares would now own 100 shares. This increase in share quantity allows the shareholder to pursue a variety of investment strategies, such as selling calls or looking into more reasonably priced options. Trade in the opinion of experts. A stock split doesn't change the total value of an investor's assets in the company over the long run, though it is theorized that stock splits could result in increased dividend payouts should Tesla decide to offer dividends in the future. Stock splits have benefits like making shares more affordable and possibly rekindling investor interest, but they can also introduce volatility frequently seen in a sell-off post-split. If another stock split is announced, Tesla might witness a 50% or greater increase in value due to active investor activity and strengthening market conditions. Tesla has seen significant inflows of retail investors, and as the market as a whole starts to exhibit comparable trends in 2024, Tesla stock could see a large increase. It is anticipated that Tesla stock could surpass $1,300 per share in the latter half of 2024, especially if it maintains its strong performance in the short term. This is due to factors like the introduction of fully autonomous driving technology in the Chinese market and positive economic indicators like declining inflation with significant when it comes to 2024. The financial scene is buzzing with the possibility of several rate cuts reminiscent of the economic strategies seen in 2020. While these cuts may not reach the extreme lows of the pandemic era, they do suggest a shift towards a more accommodating monetary policy, which could lead to increased market liquidity, stimulate economic growth, and positively impact investor sentiment. Now let's consider a few questions. Purchasing Tesla stock solely for the possibility of a stock split is not advisable. However, the possibility of a significant boost in the company's stock value due to a split cannot be discounted. What impact would these projected rate cuts have on your investing tactics? Do you believe that this is the beginning of a more strong economic recovery? How may Tesla, a major stock market participant, manage and profit from this shifting financial landscape? Please feel free to contribute your ideas and join the conversation. If you felt this material was enlightening, don't forget to hit the like button. Additionally, for additional updates and analysis on the changing dynamics of the market, subscribe to Tesla Hype. We appreciate you viewing, and we hope to see you in our upcoming videos.